webinar. Today we'll be going over some fundamentals and some great information that we believe is a very interesting statistics and very interesting graphs that we've found that do show quite conclusively that we believe now is the time to get stuck in and to start investing and be ahead of the curve. So I'd like to remind you too that we won't be taking any questions during the event, but there will be an opportunity for questions at the end as we'll be redirected to our landing page, which will certainly give you some help from there. So without any further ado, let's get started and get cracking on a great presentation about why now is the time to get investment ready. So first of all, a bit about us. Myself, as I said, I'm Anthony Sewell. Been in the finance and investment property industry for about 28 years now. Property Investment Store, we established that in 2007. The idea was we really wanted to start up a business that was really about educating and journeying with people through their property investment model and strategies that they're looking to employ in their lives. We're very numbers focused. Everything we do is based on numbers. We don't have the real estate sales pitch approach in what we do. We're very much about looking at people's individual situations and trying to design strategies that suit their needs. So let's get stuck into it. We'll move ahead and we'll start with some basics. So I guess the biggest thing in the media right now, what we're hearing everywhere, is all this discussion and information about the cost of living. And yes, we know the cost of living is certainly hurting a lot of people. And I guess the question for you tonight is the cost of living hurting you? Well, let's have a look at some of the numbers and statistics that might help us get a bit of a grasp on if that's the case, and if it is, why that might be the case. So one interesting graph I like to use as a comparison to how people live, and this is something we've seen over many years, and we've put together over watching many people's lives over many years with their financial strategies and structures that they've got in place, mostly themselves or mostly from the experts at banks and people like that who really just want to do their best to keep people in debt. We've come up with two great slides that I think can certainly help people understand a bit about the way that we think it should be and the way that unfortunately it is. The first slide here is about what I call the perfect world. Perfect world would be quite simple. 20 years of age, you would go in, you would get your own home loan on your home. You would then get stuck in for the next 20 years. You would pay the home loan off by 40, which I call the 0 point in life, which at that 0 point means you own your home, you don't owe anything to anybody, and you're in a position now to start worrying about your investment for your future, for your retirement. And at 40 years of age, the idea would be just get started in investing and work through the investment strategy until you're 60 years of age, where then obviously you could retire comfortably until you're 85 or however old you are. So that would be the perfect world, perfect scenario. And have I seen that happen ever in people's lives? Very rarely, but it's one of those ones that we certainly would love to aim to be able to achieve for most people if we possibly could. Unfortunately, the versus the real world that we see quite often, if someone was lucky enough to go and be able to buy their first home at 20 years of age, which is going to be very rare now. We believe the statistic now for Gen Zers or Gen Zers, they are not going to be buying their first home now till they're 40 years of age. But let's say they were able to buy it when they're 20, or they did buy when they're 20. Unfortunately, the average 55-year-old person we see now still owns around about a third of the value of their home, no matter where they live. So the problem is that most 55-year-olds are still in a world of pain of debt at the age of 55, with only 5 to maybe 10 years to retire. That problem then means that this perfect world situation brings this debt of their home loan right up into their supposed retirement, and then their zero position, if they're even lucky to get to that point, won't happen until they're in their late 60s or even early 70s sometimes. And this is a number we see way too often, and a situation we see way too often. And it's something which we believe is certainly very painful for people's lives, and we believe we can certainly help to bring that number down a bit and rescue some of that situation for people. The next graph is one of those painful graphs to look at, but it's unfortunately very true. So just think about when you guys started work this year in January, you came back from your Christmas break all refreshed and all happy and all wonderful, and you got stuck into work in January and February and March. Well, every one of those months, so all 3 of those months, you were going to work purely to just pay your tax bill. Then you went to work between April, May, June, July, and August, and you went to work then just to pay your home loan off. The September to October period that we're a November period towards the end of the year, that's the period that then obviously you would spend that entire 3 months paying for the rest of your bills for the year. And if you're very, very lucky, and some people aren't, some people would still be paying bills, but if you're very lucky, you may have 1 month there where your entire year that you've gone to work for has actually been for you. It's an unfortunate position to be in. Certainly, we believe we can help with the largest chunk of that. We believe we have remedies and ways of being able to reduce that home loan situation and get that down to zero. We also believe there's ways to minimize that tax side of things there as well and reduce that down a bit too. So tax avoidance is illegal, tax minimization isn't. So ideally we want to try and minimize the tax you pay legitimately there through different investment structures and strategies, and obviously get rid of that home loan. The bills, well, that's on you. It's up to how much you spend and how much you treat yourselves, but that is up to you. And certainly if we can reduce that home loan and reduce that tax debt, then hopefully the U section there increases substantially. And that's what we'd love to see people be able to achieve. So let's have a look at some real numbers. This is from the RBA and ABS statistics in regards to real household disposable income per capita. As you can see, in the last few years, it's dropped substantially. So the crisis that everybody is talking about in the sense of the cost of living, it's very true. Things have gone up. The disposable income in most people's households has gone down terribly, and there's just not enough income coming in to pay for all the fun things in life. And that's unfortunately a sign of the times, but also we believe it's a sign where you need to look at other strategies of being able to fix that problem for yourself. So since 2000, house prices have risen nearly twice as fast as household incomes have risen. This is another problem we're seeing too. And look, if you're a homeowner now, that can only be a good thing in some ways because the value of your home's gone up. But if anyone's looking to get into the market, looking to buy, it's a terrible thing because your money you're earning is worth less and less and less versus what the property values are going up. So unfortunately, getting into the property market right now on the incomes that people have in their lives is getting harder and harder. And that's certainly something that we believe there are fixes for that problem as well. So if we have a look at the average loan size for owner-occupied dwellings throughout Australia, as you can see, there's some quite interesting numbers there, everything from sort of the low of Tasmania there, right up to the high of New South Wales. And that's changed quite substantially since July 2023 to July 2024. You know, those numbers have jumped quite a bit. Even the national average has jumped quite substantially. And that is very hard. I mean, just that difference there in the average loan size is a massive difference in New South Wales. You know, how you're supposed to afford to be saving at the rate that these sort of numbers are going up. It's very painful for people to be trying to keep up with the market and get into the market. I've used a calculator here just to show you using that New South Wales average loan size of $782,000. I've used an interest rate of 6.45% and a principal and interest term here, just to show you a bit about how the numbers work and how, how much they don't work necessarily in your favour, but they work wonderfully for the bank. So if you were to look at over a 30-year term, effectively your monthly repayments on this loan would be about $4,917. So the total you'd be paying back to the bank for that $782,000 loan is effectively $770,000 over that 30 years. And the interest paid of that portion would be $988,000. So the banker certainly would be earning a lot of money over the time. And you might think, oh yeah, but we'll pay that off faster. But that's not the case, because most people I see at 55, when they still owe a third of the value of their home, they might owe $650 now on their home. But when they bought their home 20 years ago, their mortgage was only $250, because their mortgage has increased substantially since then due to the fact that they've refinanced for a pool that had to be put in, or extension on the house, or a wedding, or a holiday, whatever it might be. They've extended that mortgage out further and further, which means that every time they refinance their home loan, they're refinancing it now for another 30 years. So these are the problems that people face. And this interest bill is something that the bank are just loving, because the more they can lock you in to your home and make you, put you in a position where you have no way out other than to keep paying that mortgage to have somewhere to live, then they've got you. And this is the problem, which we want to help people be able to get out of that problem. If you look at the numbers there, I've done the next numbers based on an interest-only version of the same numbers. And that, as I said, the monthly repayments are $4,203 a month. So if we go across to break that down a bit, that means that based on the average New South Wales home loan size of $782,000, you're only paying off $714 off your principal each month. That means that you are paying the bank $4,203 per month in interest payments. That's about $50,436 per annum in interest after tax. So you've got to pay your tax first from your wages that you earn, and then you're paying your mortgage payments. So over 30 years, that works out to be $1,513,000 in interest over 30 years if that was to continue. So obviously, if you're reducing it, the interest reduces, but so many people don't. They seem to increase it and then just get themselves into more trouble. So why are house prices going up so fast? Okay, so we hear about the houses still going up, but interest rates are high. So how does that work? Why would it be that house prices keep moving, yet our rates are higher than they've been in the last decade? Well, it's pretty simple. It's the old supply and versus demand analogy here, and that I'll show you how we'll see that, how it works in the graphs. But this process of if you've got high demand and you've got low supply, well, you're always going to have the problem of pushing up markets. But the numbers do tell the story, especially this graph here. I think it's fairly obvious in this graph what's going on. If you look at the blue here, the blue line, that dark blue line there is now been trending down for a few years. That's dwelling approvals. That's how many people have been building. That's pretty much a sign of the market, the sign of interest rates, and people struggling now to have the money to be able to go and build a new home. So that's a pretty obvious sign there. The red sign is a sign of net arrivals. So in other words, the people that have been coming into Australia, and this is a monthly figure over here, and you're talking about effectively 45,000 people a month have been coming in over here. That's a lot of people to be coming into the country. So if we look at the next slide, you can see in the last few years, during COVID, we had no one coming in, but then obviously 2022 increased a little, 2023 increased a lot, but then in the 2024 year, you're talking about 500,000 people. That was back in February. So if we now look at the numbers as they stand now, so since 2020, Australia had 25,650,000 people. As of now in 2024, 27,300,000 people. So that's over 615,300 people increase in the last 12 months that we've seen through a lot of that's through migration. If we look at, obviously in 2021, immigration did slow, obviously with COVID, as I said, but has now rebounded quickly. Australia saw a significant increase in immigration, reaching the pre-pandemic levels in 2022. In 2023, immigration rates surged even higher with an increase of over 615,000 people in the last 12 months alone, as I said. So we're seeing a massive influx of people into the country. And I think the key thing that people have to understand is that they don't bring their own homes when they come over here, right? They have to find somewhere to rent. They have to find somewhere eventually to buy. And when people are coming into this country and spending their money on rent and pushing the prices up in rent, then that eventually forces people to look at buying. So as we said here, why is now the best time to invest? I mean, interest rates are high and the market's a little flat. So why do I look at doing that now? And I think the key is, as I said before, these graphs would pretty much overlay each other. Immigration here is very important. These numbers here, as we've seen, a massive increase in immigration over the last few years, but it's almost identical to the massive increase in rental increase over here, because there's been so much more pressure put on the market from people moving in over here that all of a sudden that pressure transfers to rents, and those rents keep going up and up. As the rents keep going up and up, it becomes a point. Now that point changes from city to city, but there becomes a point where people say, hang on, why don't I just buy a place? This is crazy. These rents are too expensive. I should just buy somewhere. So this is where rents will tend to lead the market and push the market up. And we'll see, as we see this growth in rents and this spike in rents, then you'll see a flattening of that as people then start to buy into the market, and then you'll see the growth in that market in that area. So they're really quite hand in hand, these two graphs, the immigration and rents going up. And the rents going up is always a sign of markets coming up. So as I said before, supply versus demand. It's just a simple equation. You know, when it comes down to it, we don't want to see the equilibrium position here. We would like to, in the ideal world, if you're an investor, you would love your home, your investment property, to be in an area where the demand is way outstripping the supply. If you can stay in that position, then you're going to be pretty much destined to get continually good growth, because ideally that's the perfect position to be in. The equilibrium point means it's all balanced. You've got a balance of supply and demand. We don't necessarily want to be there where property is. Well, you know, very rarely. We want to be in that position where that demand is definitely greater than the supply. So why does it matter? Just to recap, higher immigration rates increase demand for housing, particularly in key cities and growth corridors. As more people move to Australia, rental demand and property prices tend to rise, especially in areas with limited housing supply. A rise in immigration often drives up demand, pushing property prices higher due to increased competition. So a bit of a recap there. So I guess this begs the question, how can I afford to invest while I am being affected by the cost of living? That's a good question. And it's one that we believe is possible to do. I mean, buying investment property is not about an emotion. It's about numbers, and it's about making the numbers work for you and your situation. Everybody's situation is different. Everybody has a different position in life, a different circumstance, a different need, a different want, a different why, a different purpose. And I think what it comes down to is we want to be able to look at client situations and say, what is your reason why? What is your purpose for wanting to do this? Work backwards from there and try and design numbers that suit people's lifestyles and suit people's position financially. So we believe it can be done. And we can show you some ways here where we can show you that these numbers can work for some people that might not think it's a possibility right now. We'll just go through a couple more graphs here. I don't want to bore you with all the graphs like people do, but I think they're very important, these ones. This is what's called the property clock. The idea of the property clock is, as it says, it runs like a clock. It runs clockwise. And it's a bit of a guide to just sort of tell you what the market's doing. So obviously you've got your peak, you've got your bottom of the market, you've got your rising market, you've got your declining market. The whole idea of the property clock is, you know, ideally you want to be buying at the bottom, and effectively when you do sell, you want to sell at the top. It's that simple. But there's a whole bunch of elements around this clock that give us a bit of an idea what the market's doing. Okay, so if we have a look at the property clock, peak, trough, rising market, declining market, there's all these signs around here about what actually happens in the market when you can sort of see what's happening. Gives you a bit of a sign towards something, and it points towards where the market's heading. So ideally, the position you really want to be in really is if you can pick the magic sort of 7 o'clock to 9 o'clock position. That's sort of the magic position. And I think one of the key things, one of the key indicators you will see first of all is definitely rents increasing. So as a market comes off the bottom, it'll start to see a rent increase. As you see a rent increase, you know there's pressure on that market a little bit. Then you'll start to see lower vacancy rates as the rents increase. There's more and more people looking, but there's still low vacancy rates. That's a good position to be in. Limited housing stock, house prices rising. Okay, that's the last thing that tends to happen. But that's where we want to be on for the ride. Then we want to hang on that point there, because as we see rapid increase in pricing, trade shortages, all these other things at the top here. But the idea is that if we can buy down low, we can eventually be in a position that will sell high. That's great. So this property clock does give you a bit of a guide and a bit of an understanding of how the market works. And it is fairly transparent in a lot of ways. There's indicators that you can see as you move forward. So what is a positive cash flow property? Now, I know this might be simple for some of you, but there might be some of you out there that have heard the term but never really understood it properly. And I think what it comes down to is we all hear the term, and oh, my accountant said I should buy a negatively geared property. Well, there's a word in that sentence that I don't like. Negative, okay? If something's negative, it's bad. Negative geared means, yeah, you've got an investment property, but it's costing you money to run it every week out of your pocket. And if I said to you right now, in your horrible cost of living time that we're living in at the moment, I'm going to make you spend more money now on owning investment property out of your pocket every week, you're going to think, well, I can't afford to do that. I can't survive if I do that. And it's very true. And that's where people get themselves very much caught out in investment property, because they buy the wrong property, the wrong area, not suiting their numbers, and they get themselves stuck in a position where they just now can't do anything with their lives because they've got to pay for their investment property that's negatively geared by however much a week. We don't like that. We don't want to put people in that position. We want to see positive cash flow properties. So let's go through some of this, right? So I've just done some generic examples here. Now, these would depend on areas, that depend on a lot of things, but it gives you just a bit of a guide on how the different levels of property work and where they are and where they sort of sit in the market. On the left-hand side here, you've got 0% return to 15% return, gross return on your investment. So that's the rental side on here. This is the gross rental income you're going to be getting over here, okay? So if we sort of said the Sydney housing market, generally right now, I've seen properties from the Sydney housing market returning a rental income of anywhere between 1.5% to up to 3%. That sort of that sort of rent return on the price point that's in Sydney is going to be negatively geared. You're going to be costing yourself money. And when I say that, I would say some people will be costing themselves hundreds and hundreds of dollars a week to be holding their investment properties right now in Sydney, hanging on for that growth, hanging on for the growth of Sydney. But, you know, you can only hold on for so long when you've got negative money coming in. When you start jumping from sort of 3% up to sort of 4.5%, you're in a position there where sort of your Queensland, Victoria house and land packages, they fall in there. Most of them are still going to definitely be in that negatively geared territory. All right. When you jump from about sort of 4.5% up to about 6%, you're going to be in a position that you're probably going to be negative to neutrally geared. So something around that. So depending on, once again, the land, the location, all the price points, but this sort of area, you're going to definitely see those sort of styles of property that are returning that sort of return, they're going to be roughly the negative to neutral. When you start going up for sort of your 6.5% to 8%, you're in a position where you get dual key and duplex. Very rare now that we find duplexes up this end. They're more down this end because the cost to do a duplex is more expensive than a dual key, and it does sort of eat into the numbers of the cash flow a bit. But that would be in a position there where you'd be more like neutrally geared to positively geared, depending on where you bought. Then you sort of step up to your NDIS SDA house and land packages, and also your NDIS SDA dual keys are definitely in the positive territory. The cash flow on those is very good, and you're sort of returning anywhere from about sort of 8% up to 15% with those sort of properties. So definitely positive geared territory, definitely neutral to positive geared territory. There's also probably house and land in that as well, which may be in that area there, but sort of is more sort of around this area here between the two. So there's certainly some good options at these levels to look at in regards to property and styles of property, but that gives you a bit of a guide in the sense of how the numbers work from a gross percentage return on your property and where they would roughly sit. So if we're looking at positive cash flow, we do want to look up the top end of these sort of properties to give us that cash flow to help us keep pushing along. So I've done a bit of a scribbly drawing here just to show you how this would work from a real life point of view. Let's say you have a home. Let's say you have a home loan on your home. Your current home loan might be X amount of dollars down here, but you've got all this equity up the top here. You've got all this money, as we call dead money. It's just sitting there doing nothing. You know, you might be lucky enough to have 50% of your home paid off, basically, but all that 50% up there is doing nothing. Well, what if we were to be able to use 20% plus a bit of costs to go and buy an investment property somewhere? We go and get a loan over that investment property for 80% of the value of that investment property. That loan is then sitting over here, first mortgage to itself. Your home over here is first mortgage to itself. No cross collateralization, no joining the homes together, keeping them two separate. But the advantage is you've taken 20% plus costs from over here, the 80% there. You've been able to purchase 100% plus all the costs of the property without it costing you any money, because we're using the money in the equity that you've already paid off. We're redrawing it, and we're going to use that and a bit of a buffer in there too as a holding fund, and just money that this is, we're buying a little business over here effectively, and this is going to have a little bit of holding money in the slush fund over here to run that business. So we're trying to separate it from your life. Down here might be painful paying the home loan. not much I can do about that right now. You've got to get stuck in to keep paying that. But the idea is that if we use some of that equity and run the costs and the buffer over this side, we have a big advantage then to be able to keep this thing going while it makes us money. The idea is that if we're buying a positive cash flow property over here and we have that positive cash flow, then that money effectively can run from that investment property across into your mortgage to help cover that extra bit of debt or those loan payments that you might be struggling with a bit on the home loan side. So by using the dead money, we're borrowing money to make money, to create money, to help pay off your home loan. Sounds a bit strange, but it does work because effectively we're using money as the investment side and we're funneling the money in from the income back into this side. So the idea is that if we can use that money to help pay off the debt over here, then it can be a very tax effective way to convert your own home loan effectively to tax deductible debt, which we can show you at length. But today is a more simplified version. But yes, this does work. I've seen it work wonderfully, and it does help people. And certainly the positive cash flow can be anywhere between $5,000, $10,000 to $20,000, even up to $50,000 a year in positive cash flow. You imagine you had that extra bit of money coming through your mortgage every week or every month. It'd be a mind-blowing change to your life if you could create that. And we believe you can. So inside the numbers, and if people have the right numbers to work with, we believe they can do this and they can make this happen. So just to give you a couple of slides and photos of just the homes that we've built in the past. These ones are actually our NDIS SDA homes. They are disability homes, although very hard to pick from the front there. It looks like a regular everyday house. And that's why we design them like we do. We design them to be very much a disability home that has all the elements in there for disability, but effectively they're hidden behind the fact that they are a beautiful home. That's a kitchen in one of our NDIS SDA homes, another kitchen, communal area, another kitchen, bathrooms. As you can see, they don't look like hospitals, they look nice, and that's how we design our homes. These homes get very good returns because they are housing people with a disability, and the NDIS does cover a large portion of the extra rent on top of what they pay. So there's some very good returns, up to 15%, that we do have on some of these properties, which can be certainly life savings for some people's lives and their cash flow. Another bathroom shot, bedroom shot. As you can see, nicely built homes, ducted aircon, all nicely built. I've got some example numbers here just to show you how it would work from a positive cash flow point of view. So this is a dual key property that sold a little while back. One of our clients bought this one for $530. This one was getting $2,895 a week in rent. So that's about just over $150,000 a year in rent for this property. That's about a 15.27% return. So it's very, very strong in rent return, but certainly that extra cash flow that's coming in, we can use that in a positive cash flow type of way to be able to convert that across to their home loan. So I've run some basic numbers on that too to show you how that looks. Up the top, you got $985,000 for the value of the property. The capital growth rate, I've allowed for, say, 7% as an average. The weekly rent and then the yearly rent, obviously that's taking out some things in the first year. But ideally, interest rate of, say, 6.9%, because it's an NDIS, you probably have to go a little bit higher on the interest rate. I've said we're buying this one in a trust, but we're getting a loan for the full amount. We're buying a trust to reduce the tax on that income because that income's quite huge. So we want to bring that income down as low as we can by reducing it and purchasing a trust that helps to do that. But in this example here, this property with a full loan against it would be around about $875 a week positively cash flowed, which is about $45,500 a year positively cash flowed. These clients, we did exactly what I showed you before. We use that money that they're getting there, that $870 a week. We farmed that back into their mortgage and it helped pay off the mortgage. So, it's a very, very cost-effective way of running your life when it didn't really cost you anything to do it, because we're going to borrow the money to do it, to create an income stream that can help pay your home loan off. And then in a few years' time, the idea is we could look to sell that property and then use the equity we've made in that property to pay your entire home loan off. So there's certainly some strategies and structures we can go through with you, and we can show you these sort of things. And look, we're more than happy to discuss that with you and go through and help with any further questions you have. As I said, feel free to ask any questions you have now. At the end, it'll take you across to our landing page. And I really appreciate you being with us and listening to our webinar. Thanks for coming.